So selling naked options is definitely a bit of a controversial topic in the world of options trading. I, for example, have come across many other YouTube videos or other articles that I've read of people warning others not to sell naked options in particular because you do theoretically face unlimited loss potential. And while yes, this is technically true, it's only true if you do nothing to defend your position. And so I would actually argue that not only should you be selling naked options, but in this video, I'm going to prove to you that there are many advantages to doing so. And in fact, selling naked options is what I do almost 100% of the time. And so specifically, I'm going to go over 4 of the main reasons why you should be selling naked options, 3 of which are more general, and the last one has to do with my particular style of options trading. And that last one is very important because that's the one that corresponds to how I eliminate the unlimited loss potential that comes with short naked options. Now, I do also want to preface this video by saying that if you are a beginner, if you're just getting involved in options trading and you're taking a look at the options selling approach, which in my opinion is the right approach, then you should not yet be selling naked options. For the time being, stick to credit spreads, iron condors, etc. Basically the defined risk variance of just selling a call or a put or both at the same time until you have that confidence and full understanding as to what you're doing. Now, as always, before we dive in here, in case you are brand new, my name is Scott Reese, and welcome to my channel where I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. And so with that being said, let's jump on over to my computer now and we'll get things started. Okay, let's dive in now. And so the stock I'll be using through all my examples to help illustrate my 4 main reasons here is going to be Peloton. No special reason. I just like the stock a lot because it is very liquid. And also right now, as you can see down here with the implied volatility chart, the implied volatility is expanding rather significantly. So we're seeing a nice spike here. And in case you're not aware, implied volatility, which is what this chart is showing, is simply a measurement, conceptually speaking, it's a measurement of fear or uncertainty in the market. And in this case, of course, about Peloton stock. And so if I zoom in here a bit, you can see the stock has been selling off almost every single day for the past 3 weeks. And typically when stocks sell off in a very significant way, you'll almost always see an expansion of implied volatility or fear. Right, hopefully that should be intuitive. People often get scared in the market when stocks go down. Pretty simple. And so also in moments like this, when implied volatility does expand, you will also see an expansion of the prices on all the options for the stock. And so therefore, with inflated option prices, that makes for a great opportunity to sell those options. So with that in mind, we can now come over to the trade tab and take a look at the option chain on Peloton. As you can see here, I'm in the November expiration cycle, about 46 days left to go. And so you can definitely notice just by taking a look at the prices of these out of the money contracts, both the puts and the calls over here, these are still very expensive options. So again, this is definitely a great stock to be selling options on. But of course, the big question is, how should you go about selling these options? And in my case, what I would do here, given that this stock has sold off so much, I would probably come in here and just sell one of these out of the money put contracts, just a simple naked put option. And so this brings me to my first reason as to why I would do this as opposed to selling, let's say, a put credit spread. And the first reason is when you sell naked options, you will always have a much higher probability of profit. So for example, let's say I wanted to sell this option right here. This is the 75 strike put option, and I could sell this one for about $400. And so ideally in this case, when I sell this option, I would want Peloton to remain above my strike price, right? Because by the expiration date or sometime before that, I want to be able to buy this option back for a much lower price and make the difference as profit. Or if I do hold it all the way to the expiration date, then I do want this option to simply expire worthless and go away. And in that case, I would keep the full $400 or so. But now in the event where Peloton drops even further, let's say it goes below my put strike, at what point am I still going to make some money? Because keep in mind, whenever you sell options, you can always use the credit you received when you sold the option in the first place to offset any losses you might incur. So because I can sell this put option for about $400, that means Peloton can drop a full $4 below my put strike and I'll still break even on the trade. My break-even price for Peloton is $71 per share, right? Because just to illustrate that, let's bring up the calculator real quick. I'll move this over here. If that were to happen by the expiration date, let's say by November 19th, Peloton does fall all the way down to $71 per share, I'm going to get assigned on my put option, in which case I'll have to purchase 100 shares of this stock at my strike price of 75. So again, first step here is I buy the shares at $75 per share. That's going to cost money, obviously. And then once I have those shares, if I want to get rid of them, I can sell them at the market price for $71 per share. So then I add to this 71, and that of course is a loss of $4 per share times the full 100 shares. There you go. That's a full loss of $400, the exact amount of money I sold the put for initially. And therefore, in the last step, when I add back in that $400, which I always get to keep no matter what, that means in the end, I don't make or lose any money. I just break even. And so then to give you an estimate of the likelihood of that happening, of Peloton actually falling down to $71 per share by the expiration date, we can look at this column right here in the option chain. This is the probability in the money for all these options. So all these percentages will tell you the chance or the probability of Peloton dropping down to these various prices by the expiration date. Now, unfortunately, there is no 71 strike put option, so I'll use the 70 strike to get a basic estimate. And right now it's saying there's about a 28% chance of Peloton dropping down to $70 per share by November 19th. And so just kind of eyeballing it here, that means the chance of it dropping down to 71, I would say that's around a 30% chance of that happening. And so ultimately, if there's only about a 30% chance of you losing money, that means there's a 70% chance of you making money, a very, very high probability of profit. Now, what about instead if I sold a put credit spread? Maybe I wanted to sell the same 75 strike put option, but then also buy the 70 strike put option. And so let's go ahead and set up that order so you can see the exact amount of credit I would receive for putting on that position. So we go to sell and then vertical. And then down here, you can see the order: sell one contract, 75 strike put option, buy one contract, 70 strike put option. And now the credit you're going to receive for this one is only about $140, which is less than half of the credit you would receive for simply selling the naked put option at the 75 strike. And so because of this fact, because you're collecting way less credit for a defined risk strategy, like a put credit spread, that's going to reduce your probability of profit because now you have much less credit to use to offset any losses that you might incur. Before, with the naked put option, we had $400 that we could use to offset losses. Now we only have $140. So this means our break-even point is only about $1.40 below our short put strike. So that would put our break-even price somewhere around $73.60, which is obviously much closer to the 75 strike. And so again, just kind of eyeballing the probability of Peloton dropping down to about $73.60, I would say there's about a 35-ish% chance of that happening. And so there you go. There's a greater chance that you will actually lose money on the put credit spread than if you just sold the naked put. And then one other extension from this reason, again, because you can sell naked options for more in credit, your profits are also going to be much greater on average as well. So greater profits and greater probability of profit. That's the first main reason. And then also just one more thing before I move on. One way that you can get a happy medium between a naked option and still having defined risk is just by selling a credit spread that has a very wide difference between the two strikes. Right? Currently, this put credit spread is only $5 wide. But if you made it $10 wide or $15 or $20, the wider you make this spread, the more like a naked option this position is going to behave. And of course, also, the more credit you will receive, and therefore the higher the probability of profit will be as well. But quite honestly, in my opinion, if you're considering doing maybe a $20 wide put credit spread, you may as well just go ahead and sell the naked put instead. The only real reason I would say to not do that is simply because you're either still a beginner, in which case definitely stick with put credit spreads, or you don't have the account privileges yet to sell naked options. So that's the first reason. The next reason has to do with the option Greeks. Specifically, I'm referring to Delta, Theta, and Vega. Now, if you have no idea what these things are, I do have a separate video that explains the option Greeks. I'll post a card above linking to it so you can watch it later. But simply speaking, these are just metrics that correspond to a specific option, either puts or calls, and they will tell you by how much the price of the corresponding option will change when some event happens in the market. And in the case of Delta, This one will tell you how much the price of, let's say, the 75 strike put option. You can see here the delta is 30. This will tell you how much the price of this option will change for a $1 move in the price of Peloton stock. And then theta in the next column, this will tell you how much the price this option will change for 1 day passing in time. As time marches forward, that will affect the prices of option contracts. And then Vega, the last column over here, again, it will tell you how much the price of this contract will change for a 1% move in implied volatility. And when you sell options, you can profit from all three of these things. And that's why selling options in general is the right approach, in my opinion. There are 3 different ways you can profit. That's not the case when you buy options. Right? Basically, with Delta, you can profit with this one if you get the directional move correct in the stock price. So again, in this case, if I wanted to sell this put option, ideally, I want Peloton stock to go up in price and move away from my put strike. I can profit that way. I can also profit with theta decay because as time marches forward, that will slowly deteriorate the value of all option contracts. All options slowly lose value as you get closer and closer to the expiration date. And this is something you can only make money off of when you sell options. Because again, let's say I sell this put option for about $400 today. And then let's say 2 or 3 weeks go by, and also Peloton is roughly around the same price as it is now, which is about $82 per share. Well, in that case, time decay might reduce the value of this put option from $400 down to maybe $200. And at that point, I can buy the put contract back for that lower price and make the difference as my profit. Very cool. And then lastly, I can also profit from Vega because implied volatility typically contracts most of the time. And as I explained earlier, when implied volatility expands, like what we're seeing now, go back to the charts here. So right here, this is implied volatility expansion, and this will increase the prices of options. But if implied volatility typically contracts most of the time, that means most of the time option prices are getting smaller. So once more, today I could sell that put option for about $400, but maybe in a week or 2 weeks, implied volatility has contracted down significantly, thereby reducing the value of that put option. And then again, I could buy it back for a lower price, make the difference as a nice profit. Now, the major caveat here is you will only have full exposure to the Greeks, Delta, Theta, and Vega, when you sell naked options. For example, if you focus just on Delta here, which is about 31, that means if Peloton increases in price by $1, the price of this put option will fall by about $31. And that's going to be good for me as a seller of this put option. But instead, if I sold a put credit spread, the same $5 wide one I showed you earlier, well, now because I would be buying the 70 strike put, which has a delta of 22, this is actually going to cancel out the delta on my short put option by a huge amount. So again, the delta on just the naked put option here is 31, but the delta on the put credit spread would actually only be 9. And the way you figure that is simply by taking the delta of your short option and subtracting from it the delta on the long option. 31 minus 22 is 9. So now that means if, once again, Peloton increases in price by $1, the price of the put credit spread is only going to move by $9, not 31. So in basic terms, the prices of credit spreads or iron condors, they're going to move a lot more slowly than with naked options. And that goes for all the Greeks, not just Delta, but Theta as well. These two things will cancel each other out. And same thing with Vega. When you use credit spreads or iron condors, you're going to have much less exposure to the option Greeks. And those are the things that move the prices of options. And this can definitely be a pretty big downside if you're involved in very short-term trading. Right? For example, it's possible I could sell this put option in the morning for about $400, and if Peloton had a huge rally today and maybe went up in price by $7 or $8, I could potentially buy this put option back the same day before the market closed for a nice profit. Perhaps I could buy this put back for half price. But for the put credit spread, there's no way that's going to happen. Or I would say it's extremely unlikely. You're typically going to have to be in a put credit spread position for multiple days and have to see multiple up moves in the stock price combined with some time decay and implied volatility contraction to eventually hit your profit target. But of course, one final point before I move on, the wider you make your put credit spread, the more exposure you'll have to the option Greeks. Because as I said, the wider you make your credit spreads, the more like naked options they will behave. So do keep that in mind as well. And so now moving on to the third point, and that is adjustments to naked option positions are a lot easier. And you'll collect greater amounts of credit when you do so. So for example, if I wanted to sell this put option again, just a simple 75 strike put, One thing I can do to defend this position if Peloton stock does reverse and go a lot lower is I can step in and sell an out of the money call option. Perhaps this one here at the 105 strike. And in doing so, I would collect an extra 130-ish bucks in credit. And as I explained, the more credit you collect, the more losses you can offset with that credit. Now you can make a very similar adjustment to a put credit spread, but of course, instead of selling a simple naked call option, you would come over here and sell a call credit spread. But of course, if I were to do that, let's go ahead and set it up. Go to sell and then vertical. So you can see down here, I'd still be selling the same 105 strike call option and then also buying the 110 strike call. And now I can only collect 43 bucks of additional credit, which is not really even worth doing in my opinion. Because keep in mind, after making this adjustment, now you no longer have just a put credit spread on. Now you have a narrow iron condor. And that's definitely not a bad thing, but you do want to make sure you are adequately compensated for doing this. Now you have upside risk. Moreover, let's say you went forward and made this adjustment anyway, you sold this call credit spread, but then a few more days go by, Peloton keeps dropping lower, and now you want to roll this call credit spread down even further and collect even more credit. And the way you would do that is by buying back this call credit spread and then putting on a new call credit spread with different strikes. And so now when you're doing that, you're dealing with 4 different contracts, right? You got to deal with the 105 strike call and the 110 strike call to close out your initial call credit spread. And then you've got to sell another spread with different strikes to collect more credit. And hopefully it's adequate and worth actually doing. And in my experience, when you're dealing with a lot of different contracts at the same time, it can be very difficult to get filled at a good price. It is so much easier and so much more efficient just to move around a simple naked option. If I sold this naked call initially, great. And then later down the road, if I wanted to move it down, it's much easier to do so. I just buy this one back and then sell a new contract. In this case, I'm only dealing with half as many contracts, just 2. And again, the additional credit I can collect when dealing with naked options in adjustments or putting on brand new positions will always be greater than with defined risk strategies. And that's because when you're using defined risk strategies like credit spreads or iron condors, you always have to spend some money to buy that long option, which acts as your protection. And so there we go. Those are the 3 more general reasons why I prefer to sell naked options over anything else. And just as a quick recap, those 3 reasons are with naked options, you do have much higher probabilities of profit / higher profits. You also have full exposure to the option Greeks. And then also it's so much easier and more efficient to make adjustments to naked option positions. But these 3 things are only advantages that come with naked options. They still do not remove the undefined risk or the theoretically unlimited loss potential that comes with these kinds of strategies. And that's the main reason why a lot of people out there advise against doing this. And so this brings me to my 4th and final reason, which as I explained at the beginning of this video, which corresponds to how I remove this undefined risk aspect of naked options. So again, let's focus here on the 75 strike put option. Let's say I wanted to sell this one for about 400 bucks, although the prices have changed a bit, but let's still say 400 bucks. And so of course, the big risk here is what happens if Peloton just takes a nosedive and goes from about 81.5 down to maybe 60 or 50 or even below. What if this company goes bankrupt? You have no idea. And so as long as you do nothing to defend this position, yeah, you're going to face losses all the way down to 0 potentially. But I ask you, why would you do nothing to defend a trade? It makes no sense. You have to have your defense. And of the many ways to defend a naked option position, the method I have been experimenting with and the method which has been working exceptionally well is to use the actual stock to cover my obligations on the put options or any naked options should they go in the money or should my strikes get breached. And this method is something I show all the time in my live option trading videos, so I definitely recommend you check those out. But simply stated, what I would do here is if Peloton dropped down below 75 bucks per share, below my put strike, what I would do is I would short 100 shares of the stock. And in doing so, I would effectively convert this initially naked put option into a covered put option. Because keep in mind how you go about closing a short stock position. When you short stock, you first borrow the stock from your broker, and then you immediately sell the stock in the market. And then ideally, if the stock price drops, that's what you want to have happen. At that point, you can buy the shares back. That's how you close out a short stock position. You buy the shares back, and then you return them to your broker. And then also keep in mind what happens when you get assigned on a short put option. You must buy shares of stock. So real quick, let's bring back the calculator. So let's say over the course of this expiration cycle, Peloton keeps dropping in price, and by November 19th, it falls all the way down to $60 per share. And so as I explained, once Peloton gets down to 75, at that point, I'm going to short 100 shares of stock. So basically, I borrow the shares from my broker, and then I immediately sell them in the market at a price of $75 per share. That's going to bring in money initially. And then come the expiration date, like I said, Peloton is down to maybe $60 per share. I'll get assigned on my put option and have to buy back the shares at my strike price at 75, which is the exact same price I shorted the shares in the first place. So that means if I have to buy these shares back at 75, I don't make or lose any money, at least in regards to the stock. But you will always get to keep the premium that you sold the put option for. That $400, right, that I could sell this put option for today, I will always get to keep that money no matter what. So in the end, that is actually my profit, $400. By shorting the stock, I simply cover my naked risk to the downside. I remove it. Because when I sell options, my approach is I just want to try and keep the premium that I sell the options for. And so if the options I sell expire out of the money, then great. I don't have to make any adjustments. But if I'm directionally incorrect on the trade and my strikes do get breached, then I'll use the stock to still eliminate my naked risk on the position. And the same thing applies to the call side as well. If I also had a short call on here as well, perhaps due to an adjustment I made, then if Peloton reverses and goes higher and blows through my call strike, well, in that case, I could just buy 100 shares of the stock at my strike price, and then I'm fully covered to the upside. Peloton can go to $1,000 per share and it would not matter. As long as I buy the shares right at my strike price and hold on to them, then the net effect is I won't make or lose any money on the stock price, but I'll still get to keep the premium I sold the options for. Now, of course, there is a lot more detail that goes into this method than I have said here. I'm just trying to give you a brief overview so that you understand generally how this works. But if you do want to see much more in-depth real-life demonstrations of me using this approach, again, check out my live option trading videos. I post those videos every week, typically on a Friday, and they will show you in real time all the trades that I made and adjustments I made over the past week. And so there you have it. Those are the 4 main reasons as to why I pretty much only sell naked options. There's obviously, as you saw, a lot of great advantages that comes when doing that. You just have to make sure, however, you have really good defense. Because yes, naked options definitely can be dangerous if you don't have good defense. And so with that being said, that's going to conclude this video. Thanks so much for watching, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.